In this video we're going to look at tax planning, which is tested in the 6th task of the personal tax second sample assessment. So we're told that during 24-25 Mrs. E received employment income of 58,780. So that's going to be big enough to push this person into the higher rate band, but not enough to push them into the additional rate band. There's interest of 2,470 from a building society account. There are dividends of 845, and then there's a loan of 9,000 from her employer on which she pays no interest. So let's just remind ourselves of the various allowances for the different types of income. So we know this person has savings income, and we know they're a higher rate taxpayer, so there's going to be a 500 allowance. And we also saw that there's dividend income for which there is a £500 allowance. So we can just make a note there, there's a £500 allowance for that building society interest, and there's also a £500 allowance for that dividend income. So the question asks us to identify the effect on Mrs. E's income tax liability for 24-25 if she had made each of the following changes. Assume that each of the changes is the only change made to the details above. So we're going to look at them one at a time and not cumulatively. The first one then, Mrs. E placed some of her money from the building society account into her first individual savings account. The interest received from both accounts would be the same. Okay, so notice how it says that it's the first individual savings account because there's a maximum that can be invested in these ISAs tax-free. So only 20,000 a year can be invested into these ISAs. So because this is the first one, it means that all of the money she transfers from the building society account to the ISA would be incurring interest but no tax to pay on that. So that means if we transfer money from the building society account to the ISA, then there would be a decrease in the amount of tax to pay because the ISA would be tax-free. The second one then, Mrs. E sold her shares. So if she sold her shares, again, there would be a decrease in the amount of tax to pay. Now, at the moment, there is some tax, isn't there? Because of the £845 dividend income, 500 is tax-free because that's covered by the allowance. But there'll still be tax to pay on the remaining £345. So if she sold the shares, then there would be no income tax to pay anymore. Now there would be capital gains tax, but remember this question was asking specifically about income tax, so we don't have to worry about that. Next then, Mrs. E increased the loan from her employer by £2,000. Okay, well let's just remind ourselves what are the rules for loans from employers. We can find this information in section 11 of the reference materials. So we can see that if we have a low rate or interest-free loan, well, up to £10,000 for the loan means that it would be tax-free. And if we go over that, then we have to start paying tax on the benefit. So in this case, we've got a loan of £9,000. So that means that paying no interest on this loan is not an issue. This is a tax-free benefit. But if she increased her loan by £2,000, that would now bring the total to £11,000, and therefore tax would now need to be paid on the interest. And then the last one, Mrs. E paid 1% interest on the loan from her employer. Well, that would have no impact on the tax to pay because, remember, a £9,000 loan wouldn't incur any tax to pay in the first place. So ordinarily, if she made a contribution towards this, then that would reduce the amount of tax to pay. But on the basis that the £9,000 loan is tax-free anyway, paying 1% wouldn't have any impact. It would still have no tax to pay. Let's have a look at part B of the question. So we need to complete the following statements. So Dr. Yu has total income of 110,320 for the 24-25 year. He currently pays £300 per month into a private pension scheme. He wants to know how much more he needs to pay into his private pension scheme for 24-25 in order to protect his full personal allowance. So here are the reference materials. We're looking at section 2, and there is an income limit for personal allowance of £100,000. So when you start to earn more than that, then your personal allowance becomes smaller. So there is a £1 reduction to the personal allowance for every £2 over the £100,000 we are. But when we're working out the £100,000, we will need to take into account any donations through gift aid and any payments made into private pension schemes. So we're told that he has income of 110,320, which exceeds the 100,000 limit for affecting personal allowances. So that means there's 10,320 above the limit. So the doctor will need to pay in a total amount into the pension scheme of a gross amount of 10,320. But that's the gross amount. So what we need to do is work out, well, what would be the net amount? Because he'd be paying into his private pension scheme from his net pay after tax has been deducted. So if this is the gross figure, what we need to do then is multiply by 80% to get our net figure. So we'd have 8,256 as the net amount after 20% tax has been deducted. So as long as he pays 8,256 into the pension scheme from his net pay, then his personal allowance wouldn't be affected. Now at the moment we know that he's paying £300 per month, so what we need to do then is work out how much more he needs to pay. So £300 a month multiplied by the 12 months means there's 3,600 already being paid into the scheme. So if we compare that with the 8,256 that he needs to pay, then that tells us he needs to pay a further 4,656. Okay, that's the additional payment he needs to make so that he can protect his full personal allowance. And then the second one, Mrs. S is a higher rate taxpayer. She has a company car and her employer pays all the fuel costs. The total annual fuel costs are estimated at £3,420 and the total annual private fuel costs are estimated at £1,440. The car has a scale charge of 12%. So Mrs. S has decided to pay for all of the private fuel costs from the 6th of April 2024. So Mrs. S will save how much in income tax during the year when she pays for the private fuel. So remember, if you make some contribution to private fuel, then it doesn't have any effect on the taxable benefit. It's just taxed at the full amount. There's no allowance for you making any contribution unless you pay for all of it. So if you pay for all of it, then there is no longer any benefit in kind. So car fuel benefit is in section 8 of the reference materials, where we have a base figure of 27,800. So if we want to work out her benefit in kind, we take the 27,800 and we multiply by the scale charge, which was given to us as 12%. So 27,800 multiplied by 12% gives us £3,336. So that's how much the benefit is. And we're told that she is a higher rate taxpayer, so we then need to multiply that by the 40%. So she has to pay tax of £1,334. Now, if she pays for all of the private fuel costs, then that means there is nothing more to pay on that. So she would save herself £1,334. Now remember, it tells us about how much the private fuel costs are estimated. Again, but that's not relevant for us.